Hey folks, I'm David McKnight, best-selling author of The Power Zero. In today's video, we're talking about how to beat the tax apocalypse that a lot of experts believe is coming in 2035. Yes, even if Congress just kicked the can down the road by extending the Trump tax cuts indefinitely. Let's be clear, tax cuts are never really permanent, especially when you consider our country's catastrophic fiscal trajectory. Today, I'll walk you through a real-world case study of a 60-year-old couple with $1.5 million in their IRAs. Their goal? To reposition their assets to avoid future tax hikes and get to the 0% tax bracket in retirement. Let's get started. Yes, the Trump tax cuts have been extended beyond 2026 for now, but if you think that means you're safe long term, I've got some news for you. The national debt just crossed $37 trillion and we're projected to hit $63 trillion by 2035. In fact, we just hit the point where interest alone on our debt is over $1 trillion per year. That's even more than the annual military budget. And if you think that's bad, consider this. According to Boston University economist Larry Kotlikoff, our true fiscal gap, what we've promised versus what we can actually afford to deliver under today's tax rates, is over $200 trillion. That's why former Comptroller General of the U.S. government David Walker has said that taxes will have to double if we want to avoid fiscal calamity. So even though tax rates have been extended, that window won't stay open forever. The smart move is to act while tax rates are historically low. Let's meet John and Linda, a married couple, both age 60. They've done a great job saving for retirement and currently have $1.5 million in traditional IRAs. Their current taxable income is about $100,000 per year, putting them squarely in the 22% tax bracket. Their goal is to convert enough of their IRA to get their balances down to the ideal level before taxes go up for good. Now, what do I mean by the ideal balance? Well, when you hit age 73, the government requires you to take required minimum distributions, or RMDs, from your tax-deferred accounts. And those RMDs count as income, which can push you into a higher tax bracket, cause up to 85% of your Social Security to be taxable, and raise your Medicare premiums through IRMA surcharges. So what's the ideal amount of money to have in your IRA? For most people, the ideal balance in your IRA by the time you hit age 73 is around $350,000. That's low enough that your RMDs stay under your standard deduction and don't cause Social Security taxation. By the way, if you want to find your ideal IRA balance, go to davidmcknight.com and click on the magic number calculator and input your own personal data. Okay, let's see how John and Linda can get down to the ideal balance before tax rates go up for good. They've got $1.5 million in IRAs and want to reduce it to $350,000 by the time they reach age 73. Let's also assume their money is growing by 8% per year. That means they'll need to convert at least $120,000 per year just to take care of the growth on that account. If they want to whittle the principal down to that $350,000 ideal balance, they'll have to convert around $200,000 every year for the next 10 years. And here's the great news. If their taxable income is $100,000, their conversions will bring their total taxable income to $300,000, well below that $383,900 threshold where the 24% tax bracket ends. As a reminder, the 24% bracket is the true sweet spot in the Trump tax cuts. Why? It's one of the lowest middle brackets in U.S. tax history. It spans a wide range of income from $201,050 to $383,900 for married couples in 2025. It's only 2% more than the 22% bracket, but lets you convert an extra $182,850. The marginal jump to the next bracket, 32%, is substantial, making 24% the optimal ceiling for Roth conversions. So let's say John and Linda convert $200,000 per year for the next 10 years. What is the net effect of all this Roth converting? It eliminates nearly all future RMD tax exposure. It ensures their Social Security won't be taxed. It protects their assets from future tax hikes, and it puts them in the 0% tax bracket in retirement. This is a huge deal because if tax rates double, 2 times 0 is still 0. And here's the kicker. All of this was done at today's historically low tax rates. If you're like John and Linda, approaching retirement with a large tax-deferred balance, you need a plan. The worst thing you can do is assume today's low tax rates will last forever, because they won't. Just like the Bush tax cuts became permanent until they weren't, the Trump tax cuts can be undone with the stroke of a pen by a future Congress. And when you consider the national debt, interest costs, and unfunded promises, it's not a matter of if tax rates go up, it's when. So act now. Identify your ideal IRA balance so that your RMDs can remain tax-free. Use a 24% bracket strategically over the next 10 years. Reposition your highly taxable IRAs and 401ks to tax-free by way of a Roth conversion. Remember, even if tax rates double, if you're at the 0% tax bracket, 2 times 0 is still 0. If you want help creating a customized Roth conversion plan like the one we just walked through, head on over to davemcknight.com and click on the Connect with an Advisor button. I'm happy to connect you with a vetted Power Zero advisor who can guide you every step of the way. And if you're a financial professional who wants to master this process and help your own clients get to the 0% tax bracket, head over to powerzero.com and opt into my free video training. If you found value in this video, hit like, subscribe, and that little bell so you never miss a future episode. This is David McKnight, and I look forward to seeing you on the next video.